In March 2024, BlackRock launched BUIDL, the BlackRock USD Institutional Digital Liquidity Fund, on the Ethereum blockchain. Within weeks, it became the largest tokenized US Treasury fund on-chain, surpassing Franklin Templeton's Benji fund. Larry Fink, BlackRock CEO, stated publicly that the next step forward will be the tokenization of financial assets. JPMorgan has processed over $300 billion in transactions through its Onyx digital assets platform. Goldman Sachs tokenized a $500 million real estate debt instrument in 2022. The Boston Consulting Group estimates that the tokenized asset market will reach $16 trillion by 2030. These are not projections from crypto enthusiasts. They are strategic commitments from the world's largest financial institutions. Tokenization represents the application of blockchain technology to traditional financial assets, enabling fractional ownership, 24/7 settlement, programmable transfer restrictions, and automated compliance. For institutional investors, understanding tokenization is not optional. It is the most significant structural change coming to financial market infrastructure in a generation. Tokenization delivers three structural improvements over traditional financial asset infrastructure. First, fractional ownership. Institutional-grade assets, private credit, real estate, infrastructure, typically require minimum investments of hundreds of thousands to millions of dollars, limiting access to a small universe of participants and creating thin secondary markets. Tokenization enables any asset to be divided into arbitrarily small units, represented as blockchain tokens. A $500 million real estate portfolio tokenized into 1 million tokens at $500 each would be accessible to a significantly wider institutional audience. The BCG analysis suggests that fractionalization alone could increase the addressable investor base for illiquid alternatives by 5 to 10 times. Second, atomic settlement. Traditional equity settlement requires T+2 business days. Bond settlement is often T+1 or same day but requires complex manual reconciliation between custodians, clearinghouses, and depositories. Tokenized asset settlement occurs atomically. Both the asset transfer and cash payment settle simultaneously in a single blockchain transaction, in seconds rather than days. This eliminates the intraday settlement risk that requires significant counterparty margin requirements. Third, programmable compliance. Regulatory requirements, investor accreditation, geographic transfer restrictions, lockup periods, reporting obligations, can be encoded directly into the token smart contract. The compliance logic executes automatically without manual intervention, reducing operational costs and error rates. The current live tokenized asset market provides a concrete foundation for the institutional analysis, separate from projections. Tokenized US Treasury products are the dominant category, led by BlackRock's BUIDL, Franklin Templeton's Benji, Orndo Finance's OUSG, and several others. Combined, these products held approximately $1.5 to $2 billion by mid-2024, a number that sounds modest but represents near zero assets 18 months earlier. The growth rate is the significant data point, not the current absolute size. Tokenized private credit, on-chain representations of private lending agreements, is the second largest category, with platforms like Centrifuge and Maple Finance enabling direct lending to small and medium businesses through blockchain-based credit markets. Tokenized real estate, gold, and other commodities follow, with several institutional pilots live across major financial centers. The combined live tokenized asset market was approximately $8 billion by mid-2024, small relative to the $16 trillion projection, but growing at rates that make the projection directionally credible even if the timeline is uncertain. For institutional investors, the practical question is not whether tokenization will scale, it is which asset classes will tokenize fastest, and how to position to benefit from the infrastructure build-out. The two largest tokenized treasury funds illustrate the range of institutional approaches to the space. BlackRock's BUIDL targets institutional investors with a $5 million minimum investment, aligning with BlackRock's traditional institutional client base and regulatory comfort with accredited investor frameworks. Launched on Ethereum in March 2024, it rapidly became the largest tokenized treasury product, leveraging BlackRock's distribution network and brand credibility in institutional channels. BUIDL holds cash, US treasuries, and repo agreements, a conservative money market equivalent, and pays a yield derived from the federal fund's rate-less management fees. Franklin Templeton's Benji took a different approach. Launched in 2021 on Stellar and Polygon, it was the first registered US government money market fund with on-chain share ownership tracking. Its $20 minimum investment makes it accessible to retail participants, a deliberately different market positioning than BUIDL. 4. Institutional allocators. Both products demonstrate that the technical infrastructure for on-chain fund ownership is production-ready. The regulatory pathway, a standard money market fund with on-chain records, is well established. The question for the next phase of institutional adoption is how this infrastructure scales to less liquid and more complex asset classes like private credit, private equity, and real estate. Tokenization will not happen uniformly across all asset classes simultaneously. A phased progression based on technical and regulatory complexity is the most realistic institutional roadmap. Phase 1, money markets and treasuries, is underway now. The underlying assets are already electronically recorded, regulatory frameworks are established, and the efficiency gain from on-chain ownership tracking is immediately demonstrable. Phase 2, fixed income and private credit, is in active piloting. JPMorgan's Project Guardian, conducted with the Monetary Authority of Singapore, has tokenized institutional bonds and executed cross-border settlements. Private credit tokenization through platforms like Centrifuge and Maple Finance is live, enabling on-chain loan origination and servicing. Phase 3, equities and real estate, faces more significant regulatory and legal hurdles. Tokenized equity ownership requires integration with or replacement of existing securities depositories like the DTCC. Real estate tokenization requires jurisdictional changes to land registry frameworks. These are solvable but multi-year implementation challenges. Phase 4, global interoperability, requires coordination between sovereign jurisdictions, central banks, and regulatory bodies. The Bank for International Settlements and multiple central banks are actively developing the cross-border settlement infrastructure that will ultimately enable seamless movement of tokenized assets across jurisdictions. 3 significant risks must be modeled before institutional participation in tokenized real-world assets. First, legal enforceability uncertainty. In most global jurisdictions, the legal status of blockchain token ownership as a complete substitute for traditional asset ownership has not been fully adjudicated. If a tokenized real estate fund declared bankruptcy, would token holders have the same standing as traditional fund unitholders? The answer varies by jurisdiction, by asset class, and by the specific legal structure of the tokenization vehicle. Institutions must obtain jurisdiction-specific legal opinions before treating tokenized assets as equivalent to their traditional counterparts in risk and compliance frameworks. Second, smart contract bug risk in regulated asset contexts. A bug in the smart contract governing a tokenized bond could, in the worst case, permanently lock access to the asset or enable an unauthorized transfer. Unlike traditional securities records, where errors can be corrected through centralized registrar intervention, immutable blockchain records create permanent consequences from irreversible errors. Upgradability mechanisms and multiple independent audits are minimum requirements. Third, Oracle dependency. Tokenized assets that require off-chain data to function, fund NAV calculations, commodity price settlement, real estate appraisal inputs, depend on Oracle systems for data integrity. Oracle failures or manipulation can cause incorrect automated settlements, erroneous liquidations, or mispriced secondary market trading. 5 strategic priorities for institutional investors positioning around RWA tokenization. 1. Tokenized treasury funds are ready for institutional use today. Products like BUIDL and Benji meet the technical and regulatory standards for institutional portfolio management. Evaluate them specifically as on-chain money market alternatives that offer settlement speed and programmability advantages over traditional money market funds. 2. Track flagship institutional product launches from JPMorgan, Goldman Sachs, and Franklin Templeton as leading indicators of regulatory and legal pathway maturity. When the world's largest financial institutions launch products, it signals that the legal and compliance frameworks are sufficiently developed for institutional adoption. 3. Ethereum's dominance in institutional RWA tokenization reinforces the long-term ETH investment thesis. The fact that BlackRock, Ondo, and the majority of institutional RWA protocols chose Ethereum as their settlement layer is a powerful network effect signal. 4. Engage legal counsel in your jurisdiction proactively. The legal frameworks for tokenized asset ownership are evolving. Early engagement gives institutions time to shape their participation models as clarity develops. 5. Calibrate time expectations. The $16 trillion projection is a 2030 target, implying a 5 to 7 year transition. Institutions that recognize this timeline will avoid premature large-scale exposure while building the infrastructure knowledge and legal frameworks to participate effectively as the market matures. Real-world asset tokenization is where traditional finance and blockchain infrastructure converge, and the institutions moving first will define the market structure for decades. Crypto Mechanics tracks every major development in this space with the institutional depth and analytical rigor that professional investors need. Subscribe now and stay ahead of the most significant structural change in financial market infrastructure.